Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Jon Keidan, founder and managing partner at Torch Capital, to discuss the legacy banking impact on startup innovation. Jon, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Great to be here.
Let's start off with the legacy risk. What are some of the challenges with old infrastructure?
So one of the biggest issues, and it contributed a lot to SVB, is you have companies that are massive, bureaucratic, bloated. They also, especially in the banking sector, took loans, especially over the last decade, in low interest rate environments. So it created a lot of what ultimately proved out to be bad behavior. Although it was very good for the venture industry, banks like SVB were very powerful and strong lifelines to the industry. A lot of the things that made them such friendly partners ended up really became the result of their undoing.
Yeah, well, I mean, it really seems like it was a risk management issue. And of course, you can't just hope that interest rates stay low like they did for nearly a decade.
Yeah, hope is not a strategy. And I think they did a terrible job at risk management. And that was probably the biggest factor in the undoing. But look, they had the way you win in venture, and it's a very relationship driven industry, is they did create very strong relationships. They understood the deep needs of the sector, and they were able to deliver on that. And so they tripled down as the industry grew exponentially over the last decade. And so there was no way they could right the ship quickly and maneuver fast enough as the environment changed around them.
Well, what about newer banking institutions? They don't have that legacy risk. And what's some of the reasons why?
So again, why digital and innovation continue to eat up legacy players. They're new, they're fast, they're nimble, they're built on newer tech stacks, they have smaller teams. They're starting in an environment that's much closer to where we are right now. And so we saw the power of next generation digital banks in this crisis, because where it could take, people were fleeing SVB, going to other legacy banks, it could take weeks or months to set up bank accounts. They could get you these newer digital banks like Row Banking, for instance, which is one of our portfolio companies. We're able to get you up and running in 2 hours get your accounts up and running, get you connected to treasuries if you now needed that. So the amount of nimbleness, the smaller team, the faster capabilities with a completely digital stack all really played into why we were investing in them, which we thought this could be a better option, and it really proved out to be.
Are there specific verticals within the fintech space that are more attractive than others? Do you focus specifically on mobile?
No, we started really in consumer-facing fintech, like companies like Acorns and Lily Bank and Row Banking. But then as we saw their pain points, what was also equally as important was the infrastructure layers that power them. And so we really invest on both sides of it. And both sides are changing and evolving all the time. The companies that were created 10 years ago that became the market leaders, even in this environment, have gotten too bloated and hard to create the capabilities that newer companies want or consumers want. So it's always evolving, which is creating new opportunities for us to invest.
Jon, do you think this valuation reset that we've seen over the past 18 to 24 months was a good thing for not even just the public markets, but the private markets in terms of management teams learning about better governance and profitability, and not just bloated valuations is the path going forward?
Yeah, it was a necessary reset. It was critical. Things got way out of hand on every level and unrealistic. And so it's sort of bringing things back into where they should be. It's going to be painful. And I think the valuations, we're just starting to see the true resets in the growth stages. We saw it in the public markets and in the pre-IPO markets, and now it's just really hitting the growth stages. So I think there's a lot more pain, unfortunately, to come. But I do think at the end of that, which I think will be another 9 to 18 months, we will be in a really strong position for the next, the next generation of innovation that in the next decade, we'll be starting from a much stronger foundation.
All right, Jon, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thanks for having me.